Major funding for these programs has been provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Greenberg Traurig, New York Community Bank, Bank of America. Additional funding for these programs has been provided by grants from Akron Gold Brothers, LLC, C.B. Richard Ellis, City Investment Fund, CUSHMAN and Wakefield, Eastern Consolidated, XL Realty Advisors, LP, Essex Capital Partners, First American Title Insurance Company of New York, Gemini Real Estate Advisors, GVA Williams, Hal Fettner, Durst Fettner Residential, Helmsley Spear, Herbert J. Sims and Company, Herrick Feinstein, LLP, Jackson Development Group, James D. Kuhn Real Estate Institute at Syracuse University, John Katsimatidis, Kilroy Metal Products, Marcus and Millichap, MASSEY KNAKAL Realty Services, M&T Bank, Madison Realty Capital, Meridian Capital Group, NEWMARK Knight Frank, MUSS Development, PALIN Enterprises, Rosenthal and Rosenthal, Signature Bank, Sheldrake Organization, Sterling and Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Organization.
Hello, my name is Michael Stoller, host of the Stoller Report, Real Estate Trends in the Tri-State Region. It's a tough time out there. It's only getting tougher, and you know, it's really, really difficult for a borrower to find money. And you know, before the last couple of years, some banks, certain lenders were very open. They were giving away money at higher levels. So to fill that gap, which is no longer there, there's a group of specialty lenders, preferred equity, mezzanine lenders, who've really taken a role and are providing a very valuable service to the community. As they provide the role for the service, they also charge for it. My guests today are John Estridge, principal at RCG Longview, Tim Zatara, Senior Vice President at ING Clarion Capital, Gideon Gill, Managing Director and Principal at Madison Realty Capital, and last but not least, Brad Wildauer, Partner at Apollo Real Estate Advisors and Apollo Real Estate Financing. Now, for that money that you're putting out, what type of, you know, we were talking before, you need cash flow. What do you like and what are you doing? What's the good, and where do you go today? Because nobody knows. It's a falling knife. You know, we don't know where you should even make a loan. Is it a value and everything? John?
Well, we at RCG have been looking at assets that are cash flowing. We will look at assets that are transitional, but that transitional nature has to be in front of us.
For my audience, okay, let's talk about what are those assets. What do you mean by the assets that are cash flowing and what assets are transitional? I mean, retail, condos, rental, industrial, office?
We will look at any asset that in any asset class that is producing cash flow, whether it's retail, office, industrial. We'll even do hotels still. We'll do obviously residential. And we want to see that asset producing some sort of income. Notwithstanding that, in any of our cases, we are still open to things that you may not think that we would do, whether it would be land or something more.
You will do vacant land?
We not only will do it, not that we like to do it, but if it's a good story and we can understand it, we will. We recently did 3 or 4 months ago a piece on 125th Street off of 5th Avenue, which was a piece of land that we saw some value in, even though it's going to be, or at least we hope it's going to be, a hotel, but it also had a very large component of retail. And our underwriting was very simply based on the retail. And
so, but you looked at it, it may have been vacant land, but you really could look at that land and say, hey, I'm on 125th Street, it's Harlem, it's a retail corridor. So, I mean, you're looking at it. He wasn't saying that I'm buying a piece of land like I've seen in being offered right now, you know, on the High Line, where you have to build a condo and there are no more 421As.
We would certainly not do that, except if it was at such a low basis that you could warehouse it for 3 to 5 years. But we will look at those assets, as you said, that it does not take much of imagination to know that you could build a 2-story taxpayer with parking and have an ongoing asset and have a good return to your position.
I mean, everybody knows, and the show will air right near the marathon, ING Marathon. What's ING Clarion Capital want to do today?
Well, I think as any investor in uncertain times where you don't have a lot of foresight into what's going to happen over the next 6 months, years. I mean, real estate's not an asset that you typically trade and change over very quickly. So you have to have a longer term perspective, even though we're all bridge type of lenders. We're not 10-year fixed rate lenders. We're more transitional bridge type of funds. But so you want to look at things that we think will survive the various cycles as they turn and change. And these cycles, you know, we don't know exactly where we are in the whole cycle today. We know it's probably going to be worse from here. So we don't want to be in a situation where that asset will not be able to perform if things get a little bit worse. So to John's point, if you have some cash flow in the asset already today, you've kind of protected some of your downside. You may not have protected all of it, but you've put yourself in a position where you have some protection. Unless, and we have looked at land deals too, and we will look at land deals, but again, they have to be, you know, very good infill locations. All of us have probably seen land deals shown to us that are, you know, 100 miles outside of Phoenix or someplace else that, you know, counted on a whole new generation of properties to happen.
We're really talking about here. You know, and I was saying prior to the show that each one of you have investors. I mean, you have investors who have major pension plans from around the country and around the world, you know, who are investing with you, and you know, you all have a fiduciary responsibility. You may have high net worth families. You have this responsibility, and you earn. I mean, your profitability is predicated on your returns and everything else, because you get a management fee, you get another situation, you know, and you have to send out letters to your investors, or you may call them. What do you tell them? What do you really dislike, and what do you like, and what kind of yields do you need?
Well, I mean, I would say it's interesting, the dialogue we have with our investors. You know, of late, I think they've taken the same view that we have, and that is be patient. And you know, we look, you know, I think early in the cycle, we were much more oriented towards the transitional and the development. We had done new construction, et cetera. Today, you know, we're looking to, we think the return levels are generally going to be higher, so we're looking to dial back the risk and still satisfy our return requirements. And so we're going to be more picky and choosy. You know, it's interesting talking about land deals, because we've been requested to finance a lot of land deals. And at this point, it's not so much whether I'm concerned about the basis in the land. It's when do I think that borrower can ultimately get a construction loan to actually build something on that piece of land. Because I'm not that ultimate source of financing.
But isn't that really the question for all four of you? I mean, you're really a bridge. You're not there to be the permanent, long-term money. You're there for a bridge. You need someone who's going to be able to take you out. I mean, we were talking yesterday about a transaction that you have in Garden City, an excellent property. The world is different, so that person can't take you out that fast. You know, how do you get taken out of a loan? You don't want to be there permanently, you know.
Well, it's interesting. I mean, the asset you referred to, we have an asset, the borrower did everything right. It's 100% leased, it's cash flowing, got great coverage. You know, there's nothing wrong with it. Just there's no one there to finance them today. And I think that's going to be, you know, those assets will come back, those assets will be the most readily financeable as lenders come back into the marketplace. As banks clear their balance sheets, position themselves to lend. Again, banks will start lending again. They need those earnings to ultimately write their balance sheets. So they're right now in that transition, and that financing will come for that. It's the more transitional assets. It's the development where in an environment where you don't really know what the growth appetite and the appetite for new development is. That's going to be much farther in the future, and that's going to be much more difficult to get capital for today.
But part of the reason that some of these things are happening with liquidity is these loans are more sticky than they used to be. The transition, we used to get paid off very, very quickly.
Absolutely.
In many cases on our deals, there was a lot of appetite for this permanent financing and takeout financing. In many cases, lending got so ahead of itself that we would be taken out of deals before construction is completed, before the lease-up even
Absolutely.
happened. The greed factor to get that money out the door with some of the permanent financing took money off our books very quickly. Now our loans are sticking longer, the bank's loans are sticking longer, and it's slowing down, it's muddying up the process, it's keeping things from rolling as quickly as they did before, and it makes, you know, your balance sheet is more bloated at any given time.
But getting back to your point that yes, we are, all of us, bridge lenders, and I would even go one point further, that any borrower that has to have our respective loans out for too long will eventually lose it because they can't withstand paying that much interest. But getting back to what you said, we are, and even though I think I can speak for all of us, I think that we are not in this business in this so-called, quote, loan-to-own business. We are in the business to turn our assets, return money to our investors on a return basis, on a principal basis. Notwithstanding that, I don't think that anybody in this little forum is afraid to have to go against a property if they can't. Now, we all are very practical and realize that maybe that's not our modus at all, and we will stick with people who, you know, can meet us somewhere in the middle. But the one thing I will tell you, since this forum is in New York City, that it's very hard for me to pass up anything in Manhattan in a great location that I have a great basis
but you know what?
Based on the last 25 years of being in business here.
Right, but that's Manhattan. You know, Gideon, I know you've done things in Brooklyn, you've done things in Jersey City. I mean, how do you look at things today?
You know, it's a common theme that we all seem to reaffirm to. And with the scarcity of capital, with what's going on in the overall economy, you know, the first question that we ask on any deal we see is, what is our exit strategy? And I think, you know, collectively we probably see all types of transactions right now, probably better transactions than we've seen in years from an exposure standpoint. But the concept is, and to some of the points that have been made, who is taking me out? And we don't want to be in deals for a long time because you will end up owning these properties. And to the point of, you know, I don't think any of us are a loan-to-own shop, but I think in some ways you have to look at the world as a loan with the concept of be prepared to own if something is not going to go the right way. So that really means really getting to know your property and your borrower a lot better than I think we had in previous years.
You know, prior to the show, we were trying to say, what type of yield do you need for your investors? And in order to get that yield, what are you charging a borrower today for that bridge or that area taking the next flow? What do you charge? What do you charge them? What do you want to get? What are you comfortable with getting?
Well, we have to, I mean, I think we're all, you know, have a responsibility to our investors, you know, who have an expectation of a minimum return. I mean, you know, I think we're all looking for something in the mid-teens to get to our return levels. Used to be you were able to, if you take positions more senior in the stack or more secure, you would be able to get some financing. There is no financing for the positions on our books today. So we have to look to unlevered yields from our investments that can allow us to achieve that. Now, we may not necessarily need it on every individual investment, but we have to look for it from a portfolio. So we may say we'll have some lower yielding investments to offset some higher octane investments that have higher returns, but we're going to be driving towards that return level. I don't know if anyone has a different view on that.
Maybe what is that yield? Do you want 17%? Do you want 20%? What are you going to be comfortable? What's your minimum? What's your maximum? That's what I really want to know. People want to watch this.
To really, you know, go to Brad's point, we want, you know, mid to high teens and higher if we can get it, and if it makes sense, and if the property can carry it and have an exit strategy with that high coupon. Now, there is what I would call leverage available, but it's not easy leverage, meaning it's not leverage that, you know, anybody really likes to access. And we certainly have done some cheaper overall coupons, but what we have been doing is that we have been setting up senior loans and then taking the mezz position behind that and quoting one coupon. Now, we have not been doing this for, say, deals of, say, 50, 60, 70. We've been doing it with deals of, you know, 10 to 30, where we'll bring in, you know, one of the local banks where we all probably have good relationships with, And the local banks, the small to mid-level regional banks still have capital to lend. And so we've been able to, manufacture a higher coupon that way.
The spread is definitely determined by where you are in the capital stack and where you are with the product. I mean, we all see a lot of condominium loans today, for example, whether they be unsold units in bunches within a building, or whether they be a condominium project that's not completed yet, that's run out of capital for various reasons. A capital partner is no longer able to access or fund the deal, or there's cost overruns, or whatever the reasons may be. Those are difficult deals, and they deserve higher spreads and higher returns. Where we started the conversation on cash flow assets, those types of things, obviously, we think collectively, I would believe, carry less risk, and we would price those accordingly. So the spread is relatively large, but it's very, very deal dependent.
Gideon?
Yeah, I would agree. It's definitely project by project, and I think we're all trying to pencil to a similar type, let's say mid-teens return for our respective portfolios. But again, there are different projects that will require more. The one caveat is, I think we'll have to be careful not to be seduced by rate, because I think right now you're seeing sort of like almost a capitulation factor that people almost pay, not anything, but they will pay a much higher rate than they've been used to in the past. And it's the concept of really remaining disciplined and sticking to your core competencies, which is something we really try to practice, because I think the groups we've learned that chased yield in the tougher times, or I should say in the boom times when it was really you're going after land or development, those are the first projects to suffer. And I think we all will say that I'd rather get a 0% return and 100% of my principal back than pencil an IRR of 20 and sweat it out and not know if I'm going to get that money back.
So now, we have the idea of the yields. What are the items, that you really don't want to do, and what are the items that what you like, I hear? It's cash flowing assets, good borrower, something like that. What scares you? What wouldn't you do?
Well, I think that, Gideon mentioned, these high-yielding assets, which tend to be mostly in these broken condominiums, as defined as, condominiums that could be anywhere from 50 to, quote, 90% completed, but because of cost overruns, need money to finish out. What are the issues with those assets? Well, they all follow the same pattern. There's probably at least a half a dozen to 10 floating around, not just Manhattan, but the boroughs as well. Probably
I'd
more.
say there are probably more in the boroughs.
Yeah. Well, you'd be surprised in Manhattan, but notwithstanding that, what are the issues? The issues are very simple, is that, well, when they say that they're this % completed, they're probably much less than that. Two, they tend to all have a senior loan with a senior lender that's not well. They all have contracts that if two things occur, one, you end up taking control of the asset, they have a right of rescission. So if you take control of the assets, you might lose your contracts. Two, they all have a race against time because these assets have been on the books for a while, so the senior debt is coming due very quickly. And can these people finish up the asset and meet it halfway, sell enough units to pay down, and then will the lender be in a position that if you have to renegotiate, will they be able to renegotiate?
And then I think there's a further complication in those same deals is, what's the borrower playing for? Because as time goes on, the profit gets transferred from the borrower to the banks.
Exactly.
To the extent that there is any.
What's his economics?
And at some point...
So I think what you're saying is, let's take a condominium deal with, it's a year behind, and the material costs are over there, and, it may be better for the borrower to just hand over the keys than to go into this.
Thankfully, there are completion guarantees, but you're right in that a lot of people are working for the banks at that point.
But completion guarantees are only good if the guy can complete it.
Correct. So, you're out there. I mean, we've seen, and there's been like what I like to think of as almost like the great shakeout in the last 12, 18 months of people who seem to have rushed from let's say, internet to real estate, who now are like real estate developers, and already those people are gone, and those projects are lingering.
See, they were day traders originally. They were day
day
traders to internet.
Actually, there is a well-known day trader who became a big developer in New Jersey.
Right. So they became day traders, internet, and all the rest.
It's like anything else. It's a business that attracts a lot of capital and a lot of interest depending on the cycle, and it attracted a lot of interest when things were hot.
And a lot of cowboys.
And a lot of cowboys, and it's attracting a lot of interest today from people, a lot of which are not in the real estate space today, who now see or think they see an opportunity to come in and put money to work and jump into this space. And really, we see kind of three places where we think that there's some opportunities. I mean, we have traditionally bought CMBS securities. We're still doing that. There's some places you can play there that the spreads have widened out, that it's very, very attractive paper to buy. We are obviously doing kind of new debt deals. And then there's the distressed debt world, or what people are selling at discounts. And we're all seeing that kind of paper show up on our desks too, where people are saying, you know, we want to move this off our books and we're willing to take a haircut to do it. And, you know, we could make yields on senior loans potentially that give us that kind of yield if someone's willing to or anxious enough to move that paper off their books.
You know, the hotels were a big item, and you know, now with the European market, the Asian market, all of these markets are hurting. And you know, I remember people coming to me and saying, I want to build a hotel in Long Island City, I want to build a hotel. The 27 hotels being built in lower downtown Brooklyn, the 43 being built in lower Manhattan. I mean, today, you know, and I know that Brad has seen this, and Gideon, and I assume John and everyone, you know, how do you feel about the hospitality industry today?
Listen, it's of a question, meaning every industry, every business is questionable today. Obviously, the hotel industry, which, you know, certainly did well because of a number of reasons. One, because of the dollar. One, because of the ongoing prosperity. And one, because of New York City. You have to think that it is something to be careful of. Notwithstanding that, there are some better assets than not. There's some better locations than not, better sponsors than not. And we have committed to one just recently. Now, why? Because it's right off a great location in Chelsea, and we're in there for $200,000 a key. We'll be fine, somehow, some way. And
well, yeah, it's an interesting point, because also, I mean, even in the city, I think there's assets, there's rooms that have been taken offline, there's assets that are obsolete, that need to be redeveloped. So yes, there is new stock coming in, but there's also, I think, some obsolescence and shrinkage in the stock that's occurred over the past few years. And I think the nature of the assets that are coming on are very different than the existing stock. And so in some places, I think the assets will do fine. There's going to be some assets that are really marginal, and it's going to be difficult. I mean, the number of boutique hotels that I've had come in, and that seems to me where you've seen more of the kind of the de novo type operators coming in saying, I've got the latest, you know, concept. I'm going to be the next Ian Schrager and develop the next concept. We've seen a lot of those and had a lot of requests on those, and we've generally just passed on all that.
We kind of took a stand prior to even the cycle getting bad that we wouldn't look at deals with operators that didn't have operational experience. I mean, these were real estate developers, many of them, who, like Brad said, got a piece of land and now said, I'm going to build a hotel. I'll hire a management company, and how hard can it be? Well, it's a whole different business. And so to me, you mentioned sponsorship. Sponsorship is absolutely key.
I think people have to remember a hotel, it's like, you know, each day you have to replenish the cash register because it's an operating business, and each day the customer moves out. You know, it's as treacherous as the restaurant business.
The interesting thing about hotel plays are, you know, I think we've all seen how a lot of projects didn't start off necessarily as hotel sites. They've sort of morphed into them, perhaps to save the project itself. You know, what we see now is sort of some of these hotel projects saying, oh, maybe it's going to be student housing at the end of the day because it's a similar type layout that would make sense.
Or a condo hotel.
Or condo hotel, you know, properties that really are not necessarily
intended for that. Which nobody understands what a condo hotel is anyway, but it doesn't make a difference, right?
But I think everybody here is an opportunist in the sense that we will look at anything that makes sense. Are there certain asset classes and certain points in the cap stack that we want to be in? Absolutely. But do we really want to do land and hotels? No, but I will do anything that I can see myself getting out of, and it's the same with everybody here, that they will be comfortable with.
You know, how long do you think this cycle is going to last before the banks, you know, go back into lending? You know, how long is this? You know, we don't have too many more minutes left. How long do you think this cycle is going to last in this terrible credit crisis climate?
I think next year is the year where banks will, you know, they're going to try to purge as much as they can between now and year end. There'll still be some manicuring going on next year. And what lending the banks do are going to be their best customers, who are their best sponsors, who they have long term, and are trying to continue to service those relationships. And that will likely continue into 2010. And then from there, they'll start enlarging the circle, I think. But I suspect where, you know, real competitive lending comes back could be 3 to 4 years at least.
Gideon?
Yeah, I would agree with that. I think that we're very much in a period of price discovery right now, which is making all of us retrench in some way, you know, from your conventional lenders to your private lenders. And I think that we have yet to sort of figure out where we are in, let's say, calling a bottom. And I believe that what we're going to enter is a period of, I'm not going to necessarily call it a new paradigm, but a period of sort of a reversion to the mean of what used to be the normal way of lending. And I think we could be in that period again for several years. And I think a lot of our you know, owners in the marketplace are really digesting what has taken place over the last 4 years. It really was very much a trading environment, and I think now is really a period of asset management and taking stock of what we have. Timmy?
Well, I think I'm the one person on the panel who's probably spent most of their career in commercial banking. So I've gone through one cycle at least that I had regulators and people talking to me about the loans that we did and how we handled them. And I think a couple of things happen with the commercial banking industry. One is that the pendulum tends to swing very hard one way and probably overshoots the caution side. And I think we're there now, and it's going to continue for probably 12 to 18 more months. And the second thing is that on a purging standpoint, the banks are trying to sell some of this stuff and want to sell some of this stuff and move some of this stuff off their books. But until the government, as they get through, they've started with the big guys, and it's kind of a pyramid, and they'll work their way down to all the regional banks and so forth and look at all their assets and force them to sell and get rid of some of this stuff and maybe mark it down even further than somebody thinks it needs to be marked down, but to move it off. That process will take a while, and it'll make the banks actually have to go and make that move. And that's happening, but it's happening slowly.
I wish I could ask John the question, but I've just got the idea that we've spent 30 minutes. But I think in the past half an hour, we've got a pretty good idea of why people need your services, and that you're going to continue to be there and provide a very valuable service to the community. I'd like to thank John Estridge, Tim Cetera, Gideon Gill, and Brad Wildauer. See you next week.
Major funding for these programs has been provided by grants from Capital One Bank and Perfect Building Maintenance, Murray Hill Properties, SJP Properties, Greenberg Traurig, New York Community Bank, Bank of America. Additional funding for these programs has been provided by grants from Akron Gold Brothers, LLC, C.B. Richard Ellis, City Investment Fund, CUSHMAN and Wakefield, Eastern Consolidated, XL Realty Advisors, LP, Essex Capital Partners, First American Title Insurance Company of New York, Gemini Real Estate Advisors, GVA Williams, Hal Fettner, Durst Fettner Residential, Helmsley Spear, Herbert J. Sims and Company, Herrick Feinstein, LLP, Jackson Development Group, James D. Kuhn Real Estate Institute at Syracuse University, John Katzimatidis, Kilroy Metal Products, Marcus and MILLICHAP, Massey KNAKAL Realty Services, M&T Bank, Madison Realty Capital, Meridian Capital Group, NEWMARK Knight Frank, MUSS Development, PALIN Enterprises, Rosenthal and Rosenthal, Signature Bank, Sheldrake Organization, Sterling and Sterling, Stephen Napolitano, Stonehenge Partners, Studley, the Moynihan Organization.